What we'll talk about in today's video is how you can avoid getting a bad whole life insurance policy. When you look at whole life insurance sales, particularly when people are interested in the cash value, the biggest source of buyer's remorse is when someone gets a policy and then they find out they could have had a better one. And often that better policy is the same product with the same insurance company. It could have just been set up differently. So we'll go through different ways to set up a life insurance policy and how you can avoid getting a bad policy. So with a whole life insurance policy, here's what we're going to use as the framework for today's video. We're going to pretend that you want to fund a policy with $10,000 per year. If that seems like a high number, you can chop a zero off. If it seems like a small number, you can add a zero. But we're going to use $10,000 per year to keep things simple. And we've got three different items here. We have the death benefit. This is the actual life insurance policy, meaning when you die, this benefit will be paid to your beneficiaries. Then we have you paying money in, and we've got two terms. We've got the insurance premium and then the paid up additions rider. We'll go through exactly how both of those work. And then we have the cash value. Here's what everyone is interested in. So starting with the cash value, if you're new to this, here's why people are interested in it, is because with a whole life insurance policy, the cash value is a safe place to grow your money. With whole life insurance policies, when we look at the net yields, the actual growth rate over time, typically they fall somewhere between 4 to 5% over the life of the policy. I'll explain exactly what that means when we look at some numbers, but it's safe. Regardless of what occurs in the stock market, economy, doesn't matter. I know that my money inside of a whole life insurance policy will keep going up. I can access it anytime, and if I access it through what is called a policy loan, I keep earning dividends and interest on the money that I've borrowed and what I have not borrowed, meaning you keep getting compounding on everything, and there's no penalties. As far as accessing the money, I can typically access it as early as 10 business days after starting the policy. And then here's the big one, the tax benefits. So if we do everything right with a whole life insurance policy, we can access that cash value completely tax-free. Think about that for a moment. You could put money into a policy and see it grow by 5%, and that's also a tax-free growth rate, without any risk. How attractive is that? Especially if you're in a higher tax bracket. See why particularly wealthy individuals and corporations are often interested in this product. You may have seen videos or spoken with individuals that say the wealthy put tons of money into cash value life insurance. That is true when you look at the life insurance holdings that wealthy individuals and corporations have. And the reason why is because it grows without any risk and they've got the tax benefits. That's a big reason why. Now with a life insurance policy, you can mess the tax benefits up. Any life insurance policy can become classified as what is called a modified endowment contract. The short version of this is a MEC. If your life insurance policy becomes classified as a MEC, what happens is your cash value still grows over time. There's no risk as it continues to grow. The death benefit's still paid out with a MEC, paid out tax-free that is, but if you want to access the cash value anytime, you have to pay ordinary income tax on the gains when you access it, and a potential 10% penalty tax. Again, that's if your policy becomes classified as a MEC. So we always want to avoid that. All right, let's look at different ways we can set this up and how to avoid getting a bad policy. We're going to start with option A. So with option A, you're going to pay in $10,000 per year. Let's assume you just buy a whole life insurance policy, meaning that $10,000 that you pay, 100% of it is going to go toward the insurance premium. What will happen with this type of policy is if you put everything toward the premium, you will have a very high death benefit to start. Let's assume that that is $1 million. Okay. So you've got a $1 million death benefit, a $10,000 premium that you're paying to buy that $1 million death benefit, and your cash value in the first year will be zero. You don't have anything. So what happens is you'll continue to pay that premium over time, which doesn't have to be forever. Let's assume you pay into it for 20 years in this example. As you continue to pay that 10K premium every year, what happens by the 10th year? How much have you paid? Well, by the 10th year, you would have paid $100,000. 10K per year times 10 years. Now your cash value in the first year was zero. In the second year was zero. So you have nothing there. By the third year, it begins to increase. You get more and more back of what you pay into it every year. But it is not going to be until somewhere between 10 and 15 years that your cash value finally exceeds your total payments. So what that means is if by year 14, let's say year 15, you've paid in how much? It would have been $150. Now your cash value is finally worth $150. So by paying just the premium, it's going to take a very long time to build up cash value. And what you'll see happen with your death benefit starts at $1 million, and then it gradually increases over time. Okay. So that is option A. I'm putting my full $10,000 into the premium. I start with a high death benefit as a result, but very low cash value, and it takes a long time for that to build up as well. So that's option A. I would refer to this as a perfect example of exactly what not to do. So let's keep option A here and just say no. We'll cross it out because we don't want that. So now what we can do is look at option B. And what we're going to do for this is assume we're looking at the exact same life insurance policy, but we're going to change things up with respect to where your money goes. So of the $10,000 that you pay every year, does it all have to go toward the insurance premium? It does not. You can actually choose where it goes. So with option B, what we're going to do, instead of having all $10,000 go toward the premium, we're going to put $5,000 here. And then down here in this PUA, or paid up additions rider, we'll put the other $5,000. Okay. So how much are you going to fund this policy with? If you're old school and you write a check, how much will a check be for? $10,000. 5K plus 5K. Okay. So you're going to pay the same dollar amount. Now it's broken up as to where that money is going. So you pay the same 10K every year. It could be for 10 years, 20 years, doesn't really matter. But that's what you're paying. Here's the difference. Your death benefit, because you only put half of your payment into the premium, it's not the same $1 million. Now it only starts out at $500K, about half the amount. The cash value, because you put $5,000 toward that PUA rider, guess what? In the first year, you have about $5,000. See what just happened? You got more of your payment showing up in the cash value. By the second year, now you have about $10,000. So let's assume you follow the same schedule that we just looked at. You continue to fund it with $10,000 per year every year. What'll happen is that cash value will start at 5 and 10. It'll continue to grow over time. By the 10th year, you paid in how much? $100,000. By the 10th year, you're going to have more than $100,000. You might have, call it 110. Might be closer to 105. The point is, you have more money than what you paid into the product. It didn't take 15 years just to get your money back. By reducing the premium and putting more money toward this paid up additions rider, or a cash dump in, I like to refer to it as, we now have more money showing up in cash value. The death benefit, however, starts at a lower dollar amount, but it increases faster. Now the death benefit will always be higher than the cash value typically until we hit 100 years old. If you ever look at a life insurance illustration, usually by age 100, the two become equal. With some products, it's when we're 121. Most people say, who cares? I'll probably be dead by that time. But what do you notice here? By reducing the premium and increasing the PUA payment, now we have more money in cash value up front and also more money in cash value long term. Let's look at one more option here, and then I'll take you through an exercise with looking at some illustrations. So that was option B, which is better. So that one we won't cross out yet, but we're just going to circle it in purple because we use the PUA rider there, and it's okay. It's not what I would do. Here's what I would do. Option C. And this is all with the same policy, by the way. This is how we avoid getting a bad whole life insurance policy. So you're going to pay the same $10,000 per year. What we're going to do differently, though, is we're going to ask the insurance company, hey, how low can I go on the premium? Can I put 0 in there? Like, can I just push it down as low as possible? All insurance companies are different. With the top companies, what I mean when I say that are your 4 major mutual companies, Mass Mutual, Guardian, New York Life, and Northwestern Mutual. A lot of times we can get that minimum down to about 10% of our total payment, which means we'll have a $1,000 premium because we want to fund $10K per year, and then we'll throw the other $9,000 into the paid up additions rider. Now, what's required in a case like this to prevent a MEC from occurring is what is called a term insurance rider. What this does is purchase us more life insurance up front, which prevents a MEC, which is a taxable event. This way we can still use the life insurance policy with the tax benefits that normally come with it. So adding that term insurance rider prevents a MEC from occurring. What the policy would actually look like here is the minimum premium would be about $900 and the term rider would be $100. And I'll pull up the illustration in a moment. But our out-of-pocket is the same $10,000. So with a term rider attached and such, your death benefit might be close to the same as it was in option B with $500K. Could be a little bit less to start, but we pay the same $10K per year. The difference now is this. In the first year, we have close to $9,000 instead of 0 or even $5K. By the second year, we're at $18,000. So what happens as you continue to fund that policy, you start out with a lot more and your cash value skyrockets over time. The death benefit also increases quickly. Notice it's by the 5th year is when those payments or the cash value exceeds our total payments. By the 5th year, you would have paid how much? $50,000. $10,000 per year times 5 years is $50,000. Your cash value is now worth $50,000 or a little bit more. You actually see it positive earlier than that. So what we're doing in order to avoid getting a bad whole life insurance policy is just deciding upfront where we want to put our money. And here's the cool part about this. With a policy set up like this, what do you think you're committed to? The full $10,000 that you said you wanted to pay? No, $1,000 per year, the premium and the term rider. What a lot of people we work with will do is say, hey, I want to have the option to put up to $10K per year, but I don't want to get a bill for it. Can I set it up where I'm only committed to the minimum? So that's what I'm billed for, $1K per year. And then at my discretion, I can choose if I want to add up to $10K or not. Some years I will, some years I won't, but it's up to me. The answer is yes. So you can use it a lot like a flexible savings asset, which is nice. Now, different companies have different rules on that, but that is possible. So let's walk through an exercise and look at some actual numbers here with the life insurance illustration. And we're going to look at the same exact thing we just talked about. So we're going to maximize cash value. We're going to assume you pay $10,000 per year. And how can you get the most out of that $10,000 per year? Let's have some fun. So you've got options A, B, and C, all $10K per year, all with the same life insurance company. Option A, here we go. We're only going to fund for 10 years in all of these. There's what you're paying. $10,000 per year. Okay, so that's your payment. All of your money is going toward the insurance premium. Again, the $10K per year for 10 years. After the 10th year, you pay nothing. And there's your cash value. First year, just about zero, $336. Good deal? Not really. Let's look at option B. Same exact insurance product with the same company. Everything's identical, except where is his money going? You see $5,000 going toward the premium, and then $5,000 toward the PUA rider. That results in $10K per year going in for the same 10-year period. There's your cash value. First year, about $5,000. If we were to compare this long-term, you'll see more value. We're going to look at a side-by-side in a moment. But first, let's look at option C. What do you notice here? There's your premium, $910. You also have a term insurance rider. There's the cost right there. It's a little bit more than $100, but the true minimum is the premium plus the cost of the term. The rest is going toward the PUA rider. So we see down here, we've got the same $10K per year going in, and look at your first year cash value. See what's going on here? This is fun. We're getting the same product, but we're getting a better deal just by having awareness around where our money should be going. I love this stuff. So here are the three options side by side. Which one has the most money in the first year? Option C. How about the 10th year? Option C. 20th? Option C. 30th? Option C. Option C is the clear winner. And the reason why, because everything's the same with respect to the company product and what you're funding every year, is this: the base premium and the PUA rider. Base premium dollars. First, prioritize life insurance. Secondly, prioritize cash value. PUA dollars. First, prioritize cash value, and life insurance is second. That is how most people we work with approach it. When you look at how corporations take out cash value life insurance, it is this approach. So here we go, $10K per year. This is option A. All went toward premium, nothing in PUAs. This example took 11 years to get his money back. If we look at option B, what's the difference? We'll look at the premium and PUA rider. Split 50-50. As a result, you get your money back in 8 years. And then if you look at option C, the good one, what do you notice? A $1,000 premium, plow the rest into PUAs, and you have a lot more money in cash value. That's the lesson right there. Minimizing the premium and maximizing the PUA. So how do we avoid getting a bad whole life insurance policy? Go with option C. No, here's the key, because I know this can be a lot to remember. When you put any amount of money into a life insurance policy, the question I would ask is, out of the total amount that I'm paying in, what's my premium? If it's not 10%, I would ask, how low will this insurance company allow me to set the minimum premium? That's what I want to know. Because if I know how low that premium can be, that means I know how much I can put in the PUA rider. All companies have different rules. We've got videos that really dive deep into the PUA rider rules and what the limits are. They're all different. But what I would do with any agent is just ask, how low will the insurance company let me set my premium? Or how much can I add to PUAs on top of my premium? If they say it'll MEC, no, that's not what I want to know. How much can I add to PUAs on top of my premium? If the MEC comes up, can we look at a term rider? If I know what questions to ask, that will allow me to see these options up front. Because where buyer's remorse occurs, where people feel like they get ripped off with whole life insurance, is when they're sold option A or option B, and they were never even told about option C. They just took the individual's word for it, saying, this is the best way to go, or this is how everybody sets it up. This is really where we need to dig into it, or have a third-party advisor that can help us. For example, when we work with banks, so one of our largest clients, it's about $1 billion company. Every time we look at a new product or a new purchase, even though I've got a relationship with them, you still have to go through the due diligence process where a third-party administrator, a disinterested third party is going to analyze the purchase, make sure it's suitable for the company, and then we progress to next steps. It's done every single time, no matter what. So I bring that up because regardless of the dollar amount, how we avoid getting a bad policy is going through that. So if we don't have someone to do that due diligence for us, that's okay. We just need to know how to do it ourselves and what questions to ask. So with that said, I do hope that this video was helpful. If you have any questions or comments, please feel free to leave them below. You can also DM me. I would love to get in touch and talk all things cash value life insurance. And as always, I hope this helps.